Hi friends, today we will tell you how you can make 2 crores for your retirement by only investing 6,000 rupees per month. You won't need any guidance to follow this plan. This is suggested by famous billionaire and investor Warren Buffett. In this video, we would discuss what is index funds, the benefits of index funds, and if you're a first time investor, how can you get started. Before we move forward, don't forget to like this video and subscribe to our channel FinHub. So friends, before we begin understanding what is index funds, let's first understand what is mutual funds so that you can compare them with index funds. Well, in a mutual fund, there is a fund house known as AMC or asset management companies. Some examples are ICICI Prudential, SDFC, etc. These companies usually appoint a fund manager who is an expert investor. He manages those funds on behalf of you and he keeps changing the portfolio. That's why these are called active funds. And as they say, there are no free lunches in life. So the AMC charges you a fees for this expertise and the services provided. This is called as expense ratio and it could be about 2% of your investments. Let's understand this with an example. Let's say you invest 1000 rupees in a mutual fund. So 2% of it, that is 20 rupees, would go into the kitty of the mutual fund and the balance 980 rupees is invested in the market. Now let's come to index fund. This is also a type of mutual fund, but here the investment is done in a pre-decided portfolio which tracks a particular index. It could be Sensex, Nifty or any other particular sectorial index. Since here the AMC is not actively managing the portfolio and just tracking a particular index, it is called as passive funds, and that is why the AMCs charge lower expense ratio and it could be about 0.1% in some of the funds that is available in the market. Well, India is a growing economy and so are the markets of India. So it is obvious that the indexes which represent the barometer of the growth of the markets grow as well. While choosing an index fund, you could take up any index that you desire to track. Well, still confused? Let's go into more details. India has broadly two major stock exchanges. One is NSE, that is National Stock Exchange. The other is BSE, which is Bombay Stock Exchange. Nifty 50, popularly also known as Nifty, represents one of the topmost companies in different sectors in National Stock Exchange. And similarly friends, Sensex is made out of selected 30 companies from BSE. If we compare the growth of Nifty versus the mutual funds, certainly it has surpassed some of the mutual funds as well. Now let's understand with an example how these funds track a particular index. Let's say we choose Nifty 50 and we select the fund SDFC Nifty 50. You could choose any other fund as well. So now let's say you invest 10,000 rupees. So the topmost company in the Nifty 50 as of now is SDFC Bank and the percentage is 11.68%. So that means your 1168 rupees go into SDFC Bank, and the second allocation is for Reliance Industries, which is 10.68%. That means 1068 rupees go into Reliance Industries. Similarly, the rest of the money is invested into the balance 48 companies, which is part of Nifty 50. So friends, these companies periodically get revised and so does the percentage of their contribution to Nifty 50 index. So in that case, the allocation of your funds will also get revised to track the index again. Now let's see for ourselves how has been the return during the last 10 years for Nifty 50. In December 2009, the Nifty was at about 5,000 level, but now it has reached about 12,000 levels. So that means over the last 10 years, it has seen a growth of 9.1% CAGR. And similarly, if you look at the horizon of 20 years, in December 1999, the Nifty was at about 1500 level and now it has reached 12,000 level. So the CAGR growth is about 11% roughly. Are you still waiting for the 2 crores that I promised you at the beginning of the video? Now let's look into the details and I will show you all the calculations. Let's say you start investing rupees 6,000 per month and you increase it annually at a rate of 5% per annum, and you do this for a period of 30 years. So at the end of 30 years you will have 2 crores, and here I am assuming a modest return of 10% over a period of 30 years, which is quite safe. Isn't it simple, guys? You're getting 2 crore rupees only from starting monthly investment of rupees 6,000. Let's compare this with FD, where the returns is about 7% as of now, and if you are in 20% income bracket, your returns effectively would be only 5.6%. Now I know what is your next question going to be, why I am not comparing it with mutual funds. Let's do that as well. The average large cap returns have been about 9.5% during the last 10 years in India, and the average mid cap return has been about 8.5 to 9% during the last 10 years in India. Add to that the expense ratios of the mutual fund, which could be about 2% in case of regular funds. In index funds, you are investing in the equity market, so you are going to get the benefit of lower long-term capital gain tax. This benefit is applicable when you hold any particular equity more than 1 year. In case you withdraw a benefit of more than 1 lakh in a year, you are going to pay 10% on the benefit amount, and if the benefit amount is lower than 1 lakh, you don't have to pay any tax at all. At this point of time, let me tell you, index funds are subject to market risk, and if the market goes down, your funds are also going to go down. However, this risk is much lower than directly investing in the stocks or investing in mutual funds if you don't know which funds to buy. Now, if you are a new investor and wants to know how to buy these funds, let me tell you that as well. There are mainly 3 options. First is you can directly buy from the AMC website, but you need to buy individually from each of these websites. That is, you need to buy separately the index fund from ICICI Prudential, separately from HDFC Bank, and so on and so forth. The second option is through online portals like Paytm Money, Grow, etc. They offer you direct plans of these index funds, and you can track your entire portfolio at one place. The third option is to buy through CAMS or Kavi, but you can only buy the funds in CAMS which are listed in CAMS, and same for Kavi. Well, if you haven't done your KYC yet, you just need 3 documents. First is PAN card, the second is Aadhaar, and third is your bank details. To get it done online, you could go into any of the 3 options that I told you earlier. And if you are an existing investor, you might have already done the KYC and you can directly get started. Also, you can buy the direct plan from all these 3 options that I told you, and they don't charge any additional brokerage. Friends, we hope you like this video, and in future also you want us to come up with more such informative videos. Do share, like and subscribe to our channel FinHub.